Welcome to Finance 101 by The Dope, our new finance series to keep you up to speed with the finance world. Today, we'll talk about open banking. It's not a new thing for people to be sharing their banking data. Fundamentally, open banking is when banks open up their application programming interfaces to allow third-party providers to obtain financial information of customers. This happens only when a customer consents to provide third-party providers with their banking information to further enhance the efficiency of the banking process. In other words, it allows non-bank institutions to offer the functions that are performed by a bank. A customer can authorize an app to access their information. These apps, even though run by third-party service providers, cannot access the data without the customer's consent. That is where the APIs come in. The said third parties get access to the banking data through an application programming interface (API). The third-party providers, once having gained access to the banking data, help customers manage, monitor, and facilitate transactions and other banking actions with much ease. But what are APIs? Application programming interfaces are a set of codes and algorithms that define the interaction relationship between the various components of the software. They enable different applications to communicate with one another. APIs in the past have been seen being used to bridge the gap between developers and payment networks and would also show billing details on the bank websites. But now we are open banking, APIs deliver commands to the third-party providers. Now that we are clear on what APIs are, let's see how open banking works. Open banking works when the banks make their data available in the form of secure APIs. The third-party fintechs get connected to the APIs and make use of the data that the APIs have furnished. This can happen smoothly only when a digital ecosystem is in place that efficiently facilitates the working relationship between the fintechs and the banks. Once all the parties involved in the open banking initiative agree on the instructions on how the third parties can use the bank-provided customers' data, the banks can implement the APIs and the open banking can work smoothly. The data that is open for the third parties includes account data. This can include account holder's name, account type, currency, date on which the account was opened, other transaction details like amounts or merchants, and product data. This is the data regarding the financial services and products that financial institutions offer. Open banking is quite a trend, so much so that according to a UK-based research of 2018, it stands to boost the GDP of the UK by €1 billion annually. 71% of the financial institutions feel that open banking is a positive initiative, and 77% agree that it is a radical change for financial services. 84% of financial services companies are investing in open banking services and products. 77% of banks in Europe plan to invest in open banking initiatives for their commercial customers. 8 out of 10 financial firms are adopting or planning to adopt open banking or are interested in doing so. This was just in the UK, and in 2018, the global open banking market has grown exponentially. It was expected to be valued at $13.9 billion in 2020, was expected to grow from $15.13 billion in 2021 to $19.14 billion in 2022 at a compound annual growth rate (CAGR) of 26.5%. Currently, the market is projected to grow to $48.13 billion in 2026 at a compound annual growth rate of 25.9%. Many forecast the global open banking market to reach $123 billion by 2031. Corporates expect open banking to provide them with better banking access, with wider options and larger reach. The global percentages are 27% is to gain access to convenient and innovative banking services, 22% is to allow them to reach more clients and partners, 18% is for optimizing the efficiency of SME and corporate processes, and 18% again for reducing complexity and implementation costs for bank connectivity. The percentages in Europe are 27% is to gain access to convenient and innovative banking services, 22% is to allow them to reach more clients and partners, 21% is for optimizing the efficiency of SME and corporate processes, and 15% for reducing complexity and implementation costs for bank connectivity. According to reports, in 2021, North America was the largest region in the open banking market, and in the forecast period, Asia Pacific is expected to be the fastest growing region. Open banking has changed the market forever. It's a revolution in itself and is all set to reach new heights in the near future.